Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Jordan Roy-Byrne of the Daily Gold. How are you today, Jordan?
I'm good. How are you?
I'm good. We're speaking here at the end of a very volatile week. Do you think you could start by giving us an explanation of why gold and silver held up for most of the week and then started their decline?
Seeing a historic sell-off in the S&P, which it rallied on the day we're speaking, but coming into today, it was really the most oversold since 2008. And if you're looking at basically one-day declines, I don't have it in front of me, but as far as some of the recent declines we've seen in recent days, those are up there with 2008 and even 1929. So the decline we've seen in stock market over the last couple of weeks has been historic. It basically, we basically had a crash over Wednesday and Thursday. That 2-day decline is it might be the second worst 2-day decline ever. I'm just guessing. And with respect to gold has been outperforming the S&P 500 at least until the last day or two. But what happens is, when you get an accelerated sell-off and then a crash, funds go bust, funds get margin calls, and so everything has to be sold, and then that starts impacting everything. So that starts impacting gold, and gold was holding up okay, and silver has been really weak relative to gold, but once gold rolled over a couple days ago or peaked, then you've seen silver really come down really hard. And so, this is what happens when you basically get a market crash. It's really what happens after the crash that is inevitably bullish for, gold, precious metals, and silver. But that explains why, we've had this big sell-off. And also, if you look at the commitment of traders reports, there's been a very high amount of speculation in gold, and so obviously that's been the case in recent months. So at some point, gold was more likely to sell off than not, and so you factor in the market crash, and then the fact that there's a lot of speculators that are long gold, that adds fuel to the fire. And also when you look at what happened in the mining stocks, following the stock market, they were coming down so aggressively historically that, that was telling you that gold was going to come down significantly. It was just a matter of time.
Absolutely. And does the GDX, GDX.J, and let's say silver ETF, are those just following the price of gold and silver?
They've kind of been leading. They oftentimes lead. There can be times where, especially in the last week or two, where they have been so much weaker than gold, and when there's such a significant disparity, that often signals that gold is going to sell off. It doesn't always happen, but like I said, when you get this kind of disparity that we've seen in the last week or so, that's very ominous for gold. But really, what we've seen in GDX and GDX.J, I have to look through my historical data in gold stocks. Going back, over 100 years, and this sell-off that we've seen, this crash that we've seen just in the last 2 or 3 weeks in the mining stocks, there's people who are 80 years old who haven't seen anything like this. It's really, it's really historic. It's almost like a once-in-a-lifetime sell-off. It's really breathtaking. And I'm honestly, I'm almost at a loss of words to describe it. I don't know, we've seen a huge decline in gold in the last couple of days, and it's, obviously there are probably some people that went bust in the sector or just elsewhere. Maybe they went bust and they had to liquidate a huge ancillary position in GDX or GDX.J. I don't know exactly what happened, but something happened yesterday, Thursday, where we saw GDX.J was down 26% when it probably should have only been down like 14 or 15%. So that what we've seen in the mining stocks is I mean, like I said, it's really a once in a lifetime event. It's been a spectacular sell-off. It's setting the stage for a huge recovery, which I'm very optimistic about. But I mean, what's going on here is, what the markets are telling us is that this is a global pandemic that's going on, and it's going to have a severe impact on the economy probably for this year. And I mean, I've seen some articles where people have been writing, well, maybe we're going to go in a global recession. I mean, if you're looking at the markets, we're already in a global recession. So, I mean, I really like the outlook for precious metals going forward, but right now, I mean, as far as when they bottom and when the next move higher, when a sustained move higher begins, that's probably going to depend a lot on, what happens with the pandemic, quite honestly, because until we see some kind of economic stabilization, until that happens, don't expect precious metals to begin a bull move. They can certainly have a great rebound because they're really oversold. But I know I've gone off track here with the question, but that's just the action that we've seen in the mining stocks is so historic that that's kind of my takeaway from it.
So really, there's no way from a technical perspective to kind of see a bottom at this point?
Well, I mean, there's been so much liquidation in the sector, and it's come so quickly that it's just, you've had a market crash. A GDX and GDX.J have just blown through major support levels day after day over the last week. And I mean, it's hard to say, looking at just looking at the chart of GDX. I mean, the next major support, basically, if it goes lower, is you're getting down to the 2015, 2016 lows. So, I mean, I never thought I'd be saying that again in my entire life. But, in technical analysis, I mean, it's still useful. But when you have a market crash and you have this kind of fear, you can just you get a sell-off that is more extreme than what you normally would expect. And so, I mean, there's extreme selling going on in the miners. But if you look at gold, for example, technically I can say gold's going to come back and retest the breakout at 1375. So, I'm quite confident of that at this point. I mean, if that wasn't going to happen, you wouldn't see GDX and GDX.J just dropping by 10% every day. So that's the technical outlook for gold is a little bit cleaner, but quite frankly, I mean, that's all I can say at this point. We have to review more sentiment data and see how the market trades when it bounces. But we're not out of the woods yet.
Absolutely. It seems like a waiting game at this point. Over the summer, you had mentioned a study of the mining industry, and it concluded that the industry as a whole was severely undervalued and at something like a 100-year low. Do you think we're close to there again in this cycle?
Well, I don't know who did that study, but it was based on mining as a whole, so it wasn't only gold and silver stocks, which I specialize in. But I think as far as commodities as a whole and just mining as a whole, if we're looking at the stocks and we're just talking about that study, then I would say they're probably even a better value than they were at that point. So, I mean, this is setting the stage for a historic bull market in gold and commodities. But the question is, when is that going to start? Is it going to start in 3 months, 6 months, 9 months, 12 months? At this point, I don't know. I mean, my guess would be as good as anybody's, but, we have to, we're seeing the policy come in, and I mean, we are going to get a very inflationary recovery at some point, but I don't know if that's imminent or if it's 12 months away or if it's 6 months away. I mean, we just don't know enough, with respect to this virus, and at what point the economy will be able to bottom out, stabilize, and move out of recession. It's too early to say, but yes, commodities and mining as a whole, I mean, this is a historic low that we're going to be making at some point this year. And, we were going to get a huge bull market coming out of it. But, then again, what people are, they're focused on other things right now, and they're focused on, probably when are we going to see the bottom? What's going to happen over the next couple months? And it's kind of hard to predict that at this point because it's so dependent on the virus and whether we can get it under control quickly or not.
Excellent. When you're analyzing some of these precious metal markets, what kind of factors do you take into consideration from a technical and a fundamental perspective? Maybe let's leave out the crisis at this point. And how do those two differ from each other?
Well, when I'm looking at gold and silver, I look at a lot of history. I look at a lot of intermarket analysis, which is a relatively new field of technical analysis that looks at how markets perform in comparison to one another. So with respect to intermarket analysis, I look at how the stock market's acting, the bond market, et cetera, all those things, currency markets, how is gold performing against the stock market? How's gold performing against foreign currencies? I look at all of those things and factor them in. History as well. I look at historical comparisons. Fundamentals with precious metals, fundamentals are pretty easy. It's basically, you can boil it down to gold is driven by falling real interest rates and a steepening yield curve. But in a falling real interest rates, that's either caused by Fed rate cuts or inflation rising, inflation expectations rising, and silver in the junior miners and also the gold stocks, they tend to do better when it's inflation and inflation expectations rising versus when it's the Fed cutting rates and you have economic fears. That is best, relatively speaking, for gold, large gold producers, gold royalty companies. So the fundamentals for precious metals are pretty easy. Too many people focus on they focus on too many things that just really don't impact the price. I mean, it boils down to real interest rates, inflation, interest rates. Think of gold as a currency, and then when silver basically it underperforms if you're kind of in a contraction or deflationary mode, but it'll outperform if you're in inflationary mode. So those are the things that I look at. In technical analysis, I focus mostly on price and price patterns. I don't take into account, I don't really care about a lot of indicators or cycles or any of that stuff. I just try and focus on price, which is the most objective thing. And with respect to where we are here and now, I'll just say, I think the next move, when we get a recovery, it's probably we're going to see a rebound in inflation expectations. So when we do get a recovery, it's going to be one that, at the very beginning, it'll probably be led by gold and gold stocks, but I think ultimately it'll be a reflationary recovery. So that'll be better for, silver, gold stocks, junior gold stocks, silver stocks. So that's what I'm looking for, over the years ahead.
When you're thinking about silver leading the way and let's say the gold to silver ratio, how do you go about thinking about that ratio, and does it still have as much meaning as it used to?
I really don't think about the ratio that often, to be honest. I just analyze gold and silver as they are, and because the ratio's been extreme for a while, and numerous people have said, the ratio's at 80. Now we're going to see silver outperform gold because it's, the ratio's dropped every time it's at 80, or now it's at 90. It's, it has to drop. And so, now it's over 100. So to me, more important than I would say focus on the trend in the ratio. Like that would be important more so than the absolute level. And then also look at its fundamentals, because silver will outperform gold when we get a rise in inflation expectations. And the problem over the last couple years is this move has been driven by the Fed shifting policy and cutting rates. But right now, we, at least in the last, several months or the last year or so, it's been a move driven by rate cuts and not rising inflation or rising inflation expectations. So that's why silver has underperformed. So I'm more, as far as a timing tool for the gold silver ratio, I would focus more on looking at inflation expectations, because when those turn around and move higher, that's going to tell you when silver will outperform gold, not, a certain level on the chart. Certainly, I mean, it's super extreme where we are here and now over 100, and, 5 years from now, 10 years from now, silver is probably really going to outperform gold. But, you might have to wait for 3 months or 6 months or 12 months for that to start to happen. So that's kind of the way I look at it.
Another useful tool that I believe you look at is the gold versus S&P ratio. Could you explain to us why this is important?
Well, this is important because you've never really had a real bull market in precious metals without gold outperforming the S&P 500. And, the only exception to that was 1985 to 1987. And that's during that period, you had a massive dollar decline, like it was down 50% or so, where everything did well, but still, precious metals did well, but they should have done a lot better, based on the size of the decline in the dollar. But if you look at history, the gold price was fixed in 1971, it was fixed until 1971. So before that point, you'd have to look at gold stocks. And in the late 50s and in most of the 1960s, the gold stocks and S&P, they did trend together, but gold stocks really saw their best and most accelerated gains when there was a multi-year breakout in the ratio of gold stocks to the S&P. So, looking at gold and the gold stocks versus the S&P 500, it's important because, again, you're not going to get like a real super bull market without precious metals outperforming the stock market. And so, until recently, we've had, we had decent moves in precious metals, but it really, now that we had this crash, those moves are gone, and you can't really look at it as that great of a bull market because you didn't have gold stocks outperforming gold. Gold was outperforming silver. And so the reason why it's important is if the stock market is outperforming precious metals, then how can you say precious metals are in a bull market? In that scenario, the bull market is in the stock market, not really precious metals as a whole. So that's why it's important. And also, for things like silver, the gold stocks, junior gold stocks, for the more aggressive, speculative areas of precious metals to do well, you really need to see gold outperforming the stock market. This is something I wrote about in the last week. If you look at the gold to the S&P 500 ratio and you look at a chart of silver, they're actually, over the last 5, 7, or 10 years, the slopes are actually fairly similar. So what happens is when you see gold outperforming the S&P 500, that will cause money and capital moving out of the stock market and then into gold. So you get more capital moving into precious metals. But from after that point, then capital starts to move into the speculative things like silver, gold and silver stocks, et cetera. So, but what we've had recently, we've had both going up together. And so what that means is a lot of capital was still investing in the S&P 500 in the stock market. Sure, some of that capital might have went into gold and, some of the larger gold stocks, but it wasn't going into the speculative areas of the sector. So for the speculative areas of the sector to really perform, you need to see gold outperforming the S&P 500. And so, quite frankly, if gold's going up, if gold stocks are going up a little bit, but the sector's not outperforming the S&P 500, the speculative areas of precious metals are going to suffer. And I mean, that's what's happened in recent quarters.
Absolutely. So once this inversion starts to turn around and you start looking at junior miners a little closer, do you mind having an associated warrant? And do the terms of the warrant make the investment more or less attractive to you?
That's a great question. I mean, it's something I was thinking about. not this month, but last month, I honestly, the warrants are, I have a whole number of thoughts on the warrants. I really, the thing is, juniors obviously have to raise money. And so they obviously have to issue warrants, but that is going to put pressure on the stock in the future, because what happens is a lot of these people who get the warrants, they just sell the stock and hold on to the warrants. And so that puts pressure on the stock until it can rise above the warrant price. So with exploration companies that are really risky and have trouble adding value, the warrant can be a real big overhang. I mean, it is a big overhang for producers, but producers have a better ability to more predictably add value, because, we need to raise money because we're going to build a mine, we're going to go into production. That's more predictable. But with exploration companies, if they don't increase their value or find more or discover something, then they have to keep raising money, and then their share structure gets out of control. And so, some of these companies, their share structures are going to be blown out, and they have all these warrants that are going to act as a cap, on the stock price when it eventually recovers, over the next year, a couple years, et cetera. So I think, as a speculator, I do like getting a warrant. I'm not one of those types who will just sell the stock and hold on to the warrant. And I mean, this is important because if we're looking for the juniors that are going to go up 10x or 20x after this bloodbath, the companies that have tight share structures and don't have a huge amount of warrants, in their share structure, the companies without that, they're going to have an easier time rising. The companies that have, unfortunately, have too many warrants and their stocks are, really low, yes, they're going to recover, but they're not going to rise as quickly or as predictably as companies that have fewer warrants. So, I mean, as an investor, of course, I like the warrants, but I'm really against the style of investing where people they just do the financing and they sell the stock and they hold on to the warrants. I mean, that in a rip-roaring bull market, that can work, but for the most part, it hurts the company. And, as we've seen in recent years, in most cases, it really doesn't pay off.
That's something to definitely keep in mind. Would you mind defining what a retail float is when you're looking at a junior, and tell us why it's important?
The retail float is basically how much of the stock is relatively actively traded. So if you're basically looking at who owns the stock, and you're stripping out kind of the long-term solid holders. So if you strip out how much does management own, how much do insiders own, how much do institutions own, how much do corporates own, you strip all those things out, then, you get the retail float. How much of your stock does retail own? And that's important because the tighter the float is, the easier time the stock has rising when there's a lot of buying. Now, unfortunately, as we've seen, that can go both ways. Really, stocks with really tight floats, yes, they can rise really strongly on good news, but when we get into a crash like we've been in, they can come down really quickly. So it's important because as I said, a tighter float means the stock is going to have an easier time rising. There's less public stock out there that the market has to chew through, if there's a lot of buying and the stock's going to rise. So stocks with tighter floats, they can make more aggressive upside moves than stocks with floats that are not as tight and have, bigger retail positions.
Are the majors going to be less attractive in the coming years because they can't replace production? And is that why juniors are have such an advantage over them?
That's an interesting question. I mean, I've from the perspective of an investor, you have to look and see how, you have to look on a company by company basis. I mean, you have to be a stock picker. So as a whole, I think the junior sector will outperform, the senior miners. But, as we've seen recently, it doesn't always happen. And, the juniors are even riskier than majors. So, to say that the juniors would be in a better position, I don't really look at it that way. I look at it on an individual by individual basis. You want to look at, if you're looking at majors, you want to look at individual majors because some are better than others. And it's the same thing with juniors. You can't own the entire junior sector. You have to look at, on an individual company basis. So I don't really look at it as majors versus juniors. I just look at it on a company by company basis.
So in that same vein, if we're looking at royalty and streaming companies, are they going to underperform on the way up because they have a fixed rate of return based on some of their agreements?
If we get into a real bull market, yes, they will underperform on the way up. If we have a repeat of what's happened over the last 3 or 4 years, where you have, a modestly increasing gold price and you don't have gold outperforming the S&P 500, in that scenario, royalty companies will outperform. But I do think we're going to go into a rip-roaring bull market, over the, not too distant future, and I think it's going to last for several years. So, yes, in that scenario, the royalty companies will underperform. But depending on how much some of those have been sold off, you could still have really good buys in that area.
Does bullion have a place in your portfolio?
My personal portfolio, it has some, and I'm want to accumulate more. And what I want to do is buy basically gold and silver, kind of dollar cost average every month, because I have a very bullish outlook over the next 20 years. I'm not one of these people who thinks they're gonna, go to the. I think they're gonna do really well, but I don't think it's like a 3 or a 4 year thing. I think they have 20 years to go up. They're not going to go up every year, but that's kind of how I see the very long-term trajectory. So I think it makes sense to dollar cost average into gold and silver and just invest a little bit every month to take advantage of the future outlook and future inflation that's coming.
Excellent. And do you have a preference to store it yourself or store it have it stored for you at a remote location, say in a sovereign country?
I'm not an expert on that. I'm not. I might get chided by some gold bugs, but I'm not too worried about. I don't think we have to worry about those types of things yet. I'm not I'm not an expert on that, so I couldn't tell you, what's better.
Excellent, Jordan. Is there anything else you'd like to share with us as we wrap up?
No, I think we covered it all.
Perfect. Could you share where people can find you and some of your writing?
Absolutely. You can find all my free work, and I produce a lot of it at thedailygold.com.
Perfect. Thanks, Jordan. If anybody has any questions or comments about today's podcast, please feel free to email me at tom@palisaderadio.com. Thanks for your time today, Jordan.
Thanks for having me, Tom.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?